Morning friends, I am Vijayamohan. I am again before you to talk about stock market investment strategies and techniques. My first question to all of you is, would you like to be as rich as Warren Buffett or our own Rakesh Jhunjhunwala? Why not? Aspire for the best, the biggest. Let your idols, let your icons be as great as Warren Buffett of the US and our own Rakesh Jhunjhunwala. Warren Buffett always said, I always knew that I was going to be rich. I don't think I ever doubted that for a moment. He didn't doubt it for a moment because he had confidence in his techniques, in the principles that he has developed, which are almost infallible, which were definitely going to make him rich. So, if they were infallible for Warren Buffett, they are infallible for any other investor like you and me. Let us learn those principles. Now, the first principle that he says is, risk comes from not knowing what you are doing. Risk comes from investing in a company which you do not know. What are the products manufactured by a particular company? What are its prospects? How the company stands in the sector in which it is? Now, if you do not know the prospects of the company and its products, then you are definitely risking your capital. So, always know the company that you are going to invest in reasonably well and then only invest. Of course, you cannot know about any company in full at any point of time. But that notwithstanding, there is something called sufficiency of knowledge. You must know sufficiently. Whatever is there in the public domain, try to know all that. Of course, you also keep a ear to the market rumors, etc., but don't go by them. The next principle that he says is, I am giving you two rules. One is, never lose your money. The second rule is, always remember the first rule. In other words, never lose your capital. That is your only mantra in the stock market. As long as you don't lose your money, the money in the stock market has only two directions, upward or downward. If it's not going downward, you are ensuring that it is going upward. As simple as that. Now, how do you ensure that? He has given lots of principles for that. The first one is, first divide your income. First is the buy decision. Therefore, how to buy? There, you divide your income and also your wealth into two portions. What you want to spend, what you want to save. Now, what you want to save, you have decided, maybe in consultation with your spouse, children and others. That portion is very important for your future. The portion which you have said, I am going to save it and invest it, that you invest first in the month. The amount which you have allocated for spending, that you spend within that for the whole month. Whatever you want to spend within the allocated amount for spending, that you spend. But the amount which you have determined to save, that you must save and that you must invest. Now, when you buy a share, say a 10 rupees share for 100 rupees, what are you getting? And what are you paying? You are paying the market price. But what you are getting as a share is value. The market price is entirely different from the value. It is much unlike other consumable goods. When you buy a banana and eat, say for 10 rupees a banana, the worth of that banana is 10 rupees for you. Its market price is 10 rupees. Everybody is buying at 10 rupees. Everybody is consuming that banana maybe within a day. And there ends the matter. But in respect of stocks, it's not the case. You are going to retain it for a long time to come. Anyway, Warren Buffett advises that you must retain for a long time to come. During which period, what happens is, the value of the stock that you have purchased multiplies several times. In fact, even on the day of purchase, if you have made your calculations right, the value of the stock is certainly more than the market price which you are paying. The market does not usually discover the full intrinsic value of the stock, and the market price may be slightly unrelated to it. Why is that? See, the future is always uncertain. Like in a car, when you are going, the rear view mirror shows you the past, the journey which is already over. That journey, by looking at the rear view mirror, or even without looking at the rear view mirror, you know what you have gone through. Analyzing that, bisecting it, making statistics on that is easy. Past is a fact, but future, the journey to come, the windshield through which you are looking now towards the coming roads, the coming journey, that is always uncertain. You have to estimate the future based on the past, no doubt, but past is not always a reliable guide for the future. Now here, the geeks, the nerds, the statisticians, the logicians, what all of them will do is, they will give you certain formulae, certain methods, certain statistics, which indicate the past, how the past has arisen. And they will tell you that the future will be exactly going to follow the past trends. Warren Buffett disagrees. I also disagree. And most successful investors disagree on that. Reason is, the company which you are buying today may have succeeded wonderfully in the past, but it may not succeed that well in the future, or it may even fail in the future. Many companies have failed. Many glorious companies of the past have failed in the future. Likewise, many companies which are failures in the past have succeeded in the future also. Therefore, never depend fully on statistics, technical analysis, past trends, and so on. Make your common sense analysis of how the future is going to be for this company. Here, Warren Buffett clearly distinguishes between an inner scorecard and an outer scorecard. The outer scorecard refers to market rumors, market tips, expert opinions, geeks, nerds, calculations of the past trends, etc., and their estimation of the future. That is the outer scorecard. Now, what is the inner scorecard? The inner scorecard is what you are estimating based on a common sense approach. Of course, you take into account all the calculations made by the nerds, etc. There is no problem. Of course, you take into account the market tips, etc., etc. Keep an ear for them. But you make your inner scorecard based on facts and your own calculation of how the company is likely to perform in the future. Now, enjoy this process. The results will come automatically. You are going to make the buy today and retain it for, say, 10 years. And that's what Warren Buffett says. If you have made the right purchase, your holding period is forever, or at least for 10 years. He says, make a purchase of a stock only if you are happy to retain it for the next 10 years, even the stock market is closed for 10 years. Your assessment should be so sure shot. That's what he says. So enjoy the process. The results will come automatically. Whatever you do, there will be a few shares, there will be a few decisions of you which will go wrong. Doesn't matter. Take it easy. As long as you make a few things, the majority of things rather, right. What goes wrong will not hurt you much. Where you go wrong, the losses will not be much. They will not be heavy. But where you do things right, the gains will be fantastic. The profits will be fantastic. That's how Warren Buffett became the second richest man in the world and now the third richest man in the world. And that assessment is after he has donated $30 billion towards charities. One of the greatest charitable persons in the world is Warren Buffett. That also you must remember. So that's why he says enjoy the process. The results will come automatically. I hope you have enjoyed the lecture. I hope you have learned some principles of Warren Buffett, and we'll go through many more principles of Warren Buffett and many other successful investors. I wish you all the best, all the success in the world. Thank you.